Welcome back to Road to Fire. We're a family of three documenting our journey to fire, financial independence, retire early. Let's chat about the best asset allocation strategies for 2021 for your investment portfolio. I will outline the three different ways to build a solid portfolio with real examples and numbers and what our future plans are in the near term. So let's jump right into it. The 100 or 110 rule is a basic way to build a portfolio. It's a great way to build a balanced portfolio when you start out investing. The rule is quite simple. You take your age, minus that by 100 or 110, and that will tell you your split. For example, I'm 31, and 100 minus 31 will have me at 69. So 31% of my portfolio should be in fixed income assets like bonds, and 69% should be in stocks or traditional equities. As you age, you continue to rebalance and adjust your portfolio. That's it. But the problem with this rule is it's a one-size-fits-all. And if you've been following my journey, then you know I advocate for creating a financial journey or plan that aligns specifically to your goals and future needs. So if you want to create a portfolio that aligns better with your financial goals, here are three different strategies you can take. But first, what is asset allocation? Asset allocation defined as an investment strategy that aims to balance risk and reward by apportioning a portfolio's assets according to an individual's goals, risk tolerance, and investment horizon. A simpler way to say it is asset allocation is the process of spreading your investments over various types of assets to guard against changes in the market. It's kind of like a way to hedge your assets over time. Now, the last 15 years are a great testament on why it's important to do this. Let me emphasize this. The selection of individual securities is secondary to the way that assets are allocated in stocks, bonds, cash, and other offerings, which will overall be able to determine your investment's results. So here are the key asset classes. First are stocks, which is quite self-explanatory. We then have fixed income assets such as TIPS or bonds. There is cash and the equivalents like money market accounts. Next, for those who are advanced investors, there is futures and derivatives. Side notes, I got a C in that class almost 15 years ago. And the last section is other, which includes things like real estate investing. To simplify things, let's focus on the meat of a portfolio, stocks and fixed income assets. Now, before you shift and adjust your portfolio, there are three key things you should consider. First, your personal goals. And I use the word personal instead of finance as you should be thinking holistically when you're designing your ideal portfolio. Where do you want to be in 5 years, or 10 years, or 15 years? Where do you see yourself? What do you see yourself doing? Answering all these questions will help you design a better portfolio. Next is your time horizon. When do you need this money? When do you plan to reach FI or FIRE, if at all? Do you plan to quit your job soon? Outlining your timeline is key to better understand how to design your portfolio. Now, I'm working on a video on our FIRE timeline and we'll be sharing that in the next coming weeks. Last key factor you should consider is your risk tolerance. I would say this is where the individualism comes in. For example, some people are sitting on just 1 month's emergency fund, while others have over 12 months or up to 2 years saved. Now think about how much risk you can tolerate as this will help you plan accordingly. But don't make any adjustments to your portfolio until you thought about these three key factors. So here are three asset allocation strategies or templates you can use to design your investment portfolio. Use these strategies as a baseline and adjust or shift as needed based on your risk, goals, and timeline. Now, I did not learn about asset allocation and how important it was until I read the books I'll Teach You to Be Rich and Quit Like a Millionaire. Both books use different strategies to achieve the same goals based on each author's need. Because personal finance is personal, there is no right or wrong way to design your portfolio. But that is a big but. You want to make sure your portfolio is at least hitting the market's average rate of return. Disclaimer: I am not a financial advisor, and this video is intended for entertainment purposes only and holds only my friendly thoughts and opinions, but if you're looking to make adjustments to your investment, consult a financial advisor. Okay, the first strategy is an income-based strategy, and I will use a simple $500,000 portfolio for all examples just for easy math. With an income-based portfolio, your focus is on receiving fixed income each month to cover your expenses. It has very low risk and is usually weighted in about 70 to upwards to 100% in fixed income assets. In this example, you would have about $150,000 in stocks and the remaining $350,000 in bonds. Your asset allocation is heavily weighted in domestic bonds or TIPS. A traditional investor with this type of investment portfolio is usually much older, retiring in a traditional sense, and looking to not work in any form or fashion. But keep in mind, anyone can create their portfolio like this because it's based on your own personal preferences, goals, and your risk tolerance. If interested, potential funds are VTSAX for the total US stock index and VBTLX for the total US bonds market. Now, number two is a more balanced approach. The author of Quit Like a Millionaire had a portfolio designed like this despite her being in her early 30s. Because in this strategy, again, with the $500,000 in your portfolio as the example, you'll have almost an equal amount of money allocated to bonds as you would in stocks. Keep in mind, both are domestic assets in this example. This would have a relatively medium to low risk and is best for those who are looking for peace of mind when investing. It's for the investor who are less risky and not necessarily looking for the highest growth, but for more emotional balance with their finances. It's a great balance between long-term and current income. Now, I've seen many of my friends take this approach, especially after the Great Recession. Potential funds are again VTSAX for the total US stock index and VBTLX for the total US bond market. Really simple to build. Now, the last strategy is all about long-term growth. Investors will more than likely have more than 70 to upwards to 100% in stocks vested in their portfolio. Now, if you read Simple Path to Wealth, this is one strategy that he talks about a lot in his book. For this example, 60% are invested in domestic stocks, another 20% in international developed world stocks, and the rest is in domestic bonds. Potential funds stay the same with here, but there's an addition of VTIAX for international assets. It's ideally designed for those early in their career, younger and interested in building long-term wealth. Now, a big caveat is that anyone can have this type of portfolio. You don't have to be a 21-year-old ding to have this type of asset allocation. It's up to you to determine your own risk tolerance that aligns with your FI goals. The risk level is presumed to be high, but that is definitely arguable as well. So what does our portfolio look like? I'll link to our latest portfolio update video, but we have a growth portfolio with over 85% of our investments in stocks. But we are working to switch a few things, which I'll explain about in a second. But just to note again, there is no simple formula that can find the right asset allocation for every individual. Find what works best for you and your plans, but keep in mind that asset allocation is one of the most important decisions that investors make and forget to do properly. So take the time to find the right portfolio balance. Our future plan is to create a more balanced portfolio than what we have right now. I don't mind being heavily weighted in stocks, but there are a few other funds I'd like to add just as a safety net. So to evaluate my portfolio, I always use this expected rate of return chart as a benchmark. On the right, you have three key periods: 10 years, 30 years, and 50 years. It is then broken out by nominal return and adjusted for inflation rate of return. Now, because inflation is real, I always look at the second column. And because I'm a relatively conservative investor, I always look at the last 30 years as my benchmark. So if my portfolio has a return at about 8% or greater, then I'm okay with my current asset mix and allocation. Use your own data or reference, but this is what I use. But in the last year, our portfolio was up over 32% because of the crazy market we all experienced. But if you look at my lifetime return since 2012 for one of our Vanguard cards, our rate of return was around 11%, which was great for me. So here's our ideal asset allocation, or the best we've seen yet. I spoke on this briefly before, but our goal is to get closer towards the Swensen model. Now, what is the Swensen model? David Swensen, along with Dean Takahashi, invented the Yale model. He then wrote a book called Unconventional Success, detailing how individual investors can mirror the Yale model in their own individual portfolios. The final product is this allocation. His annualized rate of return was around 16.5%, which is double the average market return in the last 30 years adjusted for inflation, which is amazing. Now, are we going to mimic exactly this? No, but it does help us provide a more directional way on where we should go and adjust our portfolio. I'd love to add some more REITs, international stocks, and emerging markets, as I feel there's a lot of growth in those segments. Right now, we're investing about $6,000 a month into the market, so I went back into our Vanguard cards to make slight adjustments. We have a very small amount of bonds, so attaining at least 10% by the end of 2021 is also on my radar. Now, above all else, do your research and build the best optimized portfolio you can. Don't stress about it. There are many resources, tools, podcasts, books, and sites available for you. Just take the time. Because we don't use a financial advisor, we have to stay on top of our own investing on our own time, and it's by choice. I challenge myself to continue to stay knowledgeable about investing and finance each month. I can't wait to show our portfolio allocations adjustments in a few months and compare it to the Swensen model just for kicks. So you don't want to build your own portfolio? Then don't. There are many target date index funds available at most platforms that does all the work for you. Simply plug in when you want to retire, and these funds will rebalance as needed over time. But because I am a personal finance geek, control freak, and type A, I love creating and building my own personalized portfolio. Most of the time, I just mimic those who I believe are doing it right. Don't overanalyze it, as once you set it, you don't have to check back in it more than once a year. Now, if you made it this far, thank you so much for watching. But don't forget to like, comment, and subscribe below. Until next time.